Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. My guest on today's podcast is Matt Haid. Matt is an area vice president at Gallagher. Matt has over 30 years of experience working in executive benefits and is joining us again today to discuss split dollar plans. In today's episode, we talk about plan design, including funding vehicles, taxation of premium loans, and the difference between recourse and non-recourse loans. Welcome back to the show, Matt. So let's talk some more about executive comp and specifically split dollar. So when you're working with a credit union and they've decided to investigate executive comp structures, what do you start with? How does the planning begin?
That's a great question. So there's a couple different plans that are out there, and we're going to focus today on split dollar plans. And once the decision is made that split dollar fits the needs of both the credit union and the executive, there are a lot of important factors in designing that plan and funding that plan. Obviously, the very first thing to do is to decide how much benefit you want to provide to your executive or executives. There are many studies out there. Gallagher has their own study that we do amongst our clients and then even amongst credit unions that are not clients, based on size, based on current comp, based on position that will help guide credit unions into an appropriate benefit amount to provide for their executives. So that's really the first step. How much do you want to provide? And then when do you want that to start? Doug, if you have a 40-year-old executive and you're promising something at age 65, that's a fairly long time frame there. So there are ways, again, with split dollar plan to start those a little bit earlier, or perhaps have what we call an interim payment in there, kind of like a bonus payment for staying for 5 years, 10 years. So all of those things are really the first steps, and I think are crucial into the design of the plan and how to fund that plan.
Matt, you mentioned your study, which I've always been very impressed with the scope of. Is it an annual survey that you guys do?
It is an annual survey that we do.
Yeah, and provides a lot of data on salary and benefits. And so I'm used to seeing split dollar plans somewhere in the 60 to 70% target of final comp.
I would agree with you that the 50 to 70% is typically the target. And just to further clarify that point, that's of overall benefits that are being provided by the credit union. So it's not necessarily coming just from the split dollar plan. So if there's a match on their savings plan, if there's Social Security that's being provided, if there's other type of plans. So it's all total 70%. And what you see is a split dollar plan making up any shortfall that isn't already being provided. But that target, as you said, typically between 50 and 70%.
So what's important in the design of the plans with that outcome? What do you need to be thinking about?
So a lot of very, I think, important factors that go into the design of the plan. And I think the first one is what type of vehicle is going to be used to fund that plan. The most common vehicles are index universal life insurance and whole life insurance. Each of them have key features which help mitigate risk and maximize flexibility and efficiency. When we're looking at whole life insurance policies, we are at the mercy of the mutual company as to what dividend rate is going to be provided in the future. We can't choose what that rate's going to be, and so we are at the mercy. Whole life companies, mutual companies have paid dividends for the last 85 years or so, but those dividend rates are coming down, and there's really nothing we can do to mitigate that risk of that rate coming down. The other type of product we're looking at are index universal life products, which provide returns based on market rates of return. This is a different type of investment where we're targeting a very reasonable type of return over a very long period of time. If you have a 50-year-old executive that you're providing a plan to, actuarial tables will tell you that that executive is going to live to approximately 85. So you're looking at about a 35-year time frame minimum. And so what we're trying to do is target a rate of return that's somewhere between 5 and 6%. And what we've seen with the index universal life products is that over time, because of that floor, and even with the cap, that the market indices are going to provide you with that rate of return. They're probably not going to provide you with 10% rate of return, which you may want in other type of investments, but that's not the goal here. The goal is to design the plan to give you enough return to provide the projected benefits.
How does a board decide between one or the other, or do you ever get really funky and make a combination of the two? So I know there's several questions there, but you can handle it, Matt.
No, I think I can handle it. I love being tested like that, Doug. So how does the board decide? I think it's based on the amount of risk and then the amount of cost. Very generally, we're all smart financial people here. The less the risk, the higher the cost. Right. And so when you're looking at whole life plans, they are less risk because they typically are going to provide a dividend. I can't say for certain in the future if they're going to, but based on the fact that they've paid a dividend for the last 85 years, I'm pretty certain that they're going to continue. But you're going to pay for that protection. Typically, you're going to see dollars necessary about 30% higher to provide that less risk. So the whole life companies are going to charge you about 30% more in terms of premium to provide the same level of death benefit to that executive. So they're going to decide based on their comfort level with the level of risk that they have. And the different credit unions and different boards have different levels of risk.
So in the marketplace, do you have good data on, outside of Gallagher, just the whole credit union marketplace? How much of the split dollar programs are whole life versus index?
That would be in our survey, but it's fairly balanced. You see about 50-50. I think we're going more towards the index universal life because it's a newer product. So back 10, 15 years ago, the index universal life didn't necessarily exist, or maybe one carrier had it. And so there you saw a higher percentage of plans funded with whole life. But I think we're trending to probably above 50% in the IUL. You also did mention, do you get funky and use a combo? We absolutely see that. Boards are willing to take, say, 50% of the risk with a market-based plan. And that's another possibility, is looking at a split. And there's no guideline as to what the split needs to be. It could be 50-50, could be 70-30 IUL, could be 70-30 whole life. So we absolutely see that. And any good consultant should be able to provide that type of combination.
That's interesting. And working with credit union executives all over the country, I have yet to run into someone having both structures. I see a lot of each of them, but I've not seen one person having both. So that's interesting. It does exist.
It does exist. It is not certainly what's, as you said, you don't see a lot of that out there, but they absolutely do exist. And we administer several of those plans.
So if you're more risk adverse, or maybe you also have additional deposits that you could reposition, a whole life may be more attractive. I wonder, what are your thoughts on the interest rate expectations and how the interest rate expectations of the board might inform the decision? For example, as an investment firm, we think interest rates are going to modestly increase through the rest of this year, through the rest of next year, or at a very low point in 10-year interest rates. So we would have a upward bias in anything we were positioning for interest rates. Now, in this, we're talking about something for 25 years or more. If you think interest rates are generally going to trend up, would that tend to lead you towards whole life over indexed, or would that not be the key decision point?
Well, I think dividend rates typically lag interest rates. And so it depends on the time frame that you're looking at. But I think in the long run, if you think just interest rates are going to go up, then you probably would lean toward dividends. If you think market rates are going to go up, S&P 500, Russell 2000, different type of market indices, then you'd probably lean more towards the IUL product. It's important to understand that, well, the rate needs to be reasonable. The lower rate assumption, so just because the dividend, for example, if we're looking at a whole life product and the dividend rate is currently 6%, that doesn't mean we have to run our projections at 6%. If we want to take a more conservative approach, we can run the illustrations at 5%, build in some cushion there. Now, that's going to cost more. Right? If we have a lower expected rate of return, you're going to need more premium to get to the same end point. That's just simple compound interest assumptions there. But if a board is comfortable with that and they really want to take care of this executive and make sure that this executive gets the projected benefit, remember, split dollar plans are not promised benefits, they are projected benefits. And maybe we will take a more conservative rate. And maybe if we feel that interest rates are going to go up, but they're currently at 5.5% market rates, maybe we keep our assumptions at 5.5% right now and don't use a higher rate, even though we expect it to go up, because that's just going to provide cushion and more probability that the projected benefit is going to be achieved.
I'm used to the benefit for the executive coming into play at a target retirement age, at the age at which the credit union is trying to keep them into.
Exactly.
Right? That's the whole idea.
That's the whole idea. Exactly.
Talk to me about the funding side and how the frequency of funding or how long the funding is versus short periods, a one lump sum versus payments over 5 years or payments over 10 years. How do the credit unions decide to fund these plans, and what are the best practices around the speed of funding?
So that's a great question too. It would be great if we could take a one-time premium and just dump that into a life insurance policy, but that's not how life insurance works, whether you're talking about whole life or index universal life. So there's really there's a couple of options, but the main two options are making a one-time loan. Typically, these plans in an index universal life policy is going to be funded over 7 years. A whole life policy is typically going to be funded over 10 years. Most whole life policies require 10 years of premiums, but typically you're going to see either a 10-year or a 7-year funding. What we almost always suggest is to, if the credit union has enough cash and it will not affect their concentration, there is a limit as to how much they can have in these split dollar plans as a function of their net worth. But if they have enough cash, we typically like to have them make a one-time loan. And the reason why we do that, they make a one-time loan. Some of the money is set aside for the remaining, say, 6 premiums. The first premium is paid, and then the rest of the money from that loan is set aside. The reason why we do that is because we can lock in the interest rate that's going to be charged on that loan. When a credit union does make a loan to an executive to provide a split dollar plan, they are forced to charge a minimum interest rate. That interest rate is the AFR, or the applicable federal rate, which is published monthly. And the month that you make that loan will determine what that AFR is. So if you make a one-time loan equal to 7 of the premiums, now you've locked in that AFR, and it can't go up during the life of that policy, the life of that split dollar plan. That AFR is locked in. The nice thing about it is that if AFR rates go down and the credit union is amenable, they can actually lower that rate and refinance the outstanding loan balance to that rate. By doing annual loans, meaning I'm only going to loan my participant one premium per year and do that for 7 years or 10 years in our example, I'm subject to changes in the AFR. I have no way right now of predicting what that AFR is going to be a year from now, 2 years from now, 5 years from now. And so there is a little bit of extra risk taken there, so that should the AFR go up next year and I need to make an annual loan, now I'm loaning that at a higher rate.
That is a very interesting point. I see it from when we're building out a financial plan for a credit union executive, we're projecting the next 20 or 30 years. And if the loan rate is not fixed, that means that the tax impact to the executive is a variable number that I'm trying to incorporate into their financial plan, this tax liability. Can you talk to us about the tax liability that come to the executive on the loan, how that can be fixed, how that can be variable, and the ability of credit union to choose that?
When we make a one-time loan, interest is going to accrue on that loan at the fixed long-term AFR rate. That interest is not taxable to the executive if they are not forgiving that interest. The way that the plans are typically designed is that interest will continue to accrue. The credit union gets to recognize it as income on their balance sheet, but the executive, while they owe that interest, they are not taxed on that interest. that loan will continue to accrue interest at the AFR until such time as it's repaid, and it's not repaid until the death of the executive. And so all along, even if the executive lives for 40 years, that loan is accruing interest. The credit union is recognizing that interest as income on their balance sheet. However, the executive is not paying any tax on that interest at any time.
So the tax liability that I have seen some executives have to deal with is a result of plan design in working with the executive. How is it that some do have the tax liabilities?
So that is what we would call a forgiven interest loan, as opposed to the one I described before is what we call loan regime split dollar. It's a general term in the industry. It may be Gallagher coined, it may not, but that is a general term. It's supposed to be a forgiven interest model, where that loan is actually in the other way, in the forgiven interest, that loan is accruing interest, but each year that interest is forgiven. You make $1 million loan at 3%, if that's what the AFR is at that time, then it's going to accrue $30,000 worth of interest. The credit union can decide to forgive that interest. Now, that's not very beneficial to the credit union because they don't get to recognize that income, but we do see that design every now and then. If the credit union decides to forgive that $30,000 worth of interest, that becomes taxable income to the executive, who will then have to pay tax at their personal rate on $30,000. It's going to be reported on their W-2 as income of $30,000 that they will then owe tax upon.
So if you have the forgiven interest model, if you're listening to this podcast, you have the forgiven interest model, which means there is this annual tax liability, and you'd like to do away with that. Can you do away with it, or is it permanent?
That is a fabulous question. You absolutely can do away with that. And that's what we have been doing a lot of, is taking over those plans that are on the forgiven interest model. At that, whatever time we take it over, or whatever time an amendment is signed to switch to the loan regime, that loan balance is then determined. And then that loan balance now starts to accrue interest on it. But the executive no longer has to pay tax on that accrued interest, and the credit union starts to recognize that as interest income.
I've seen that from the executive standpoint, and that's a huge win for the executive, because from my chair, I'm trying to project a tax liability for someone for the rest of their life based on an unknown tax rate and an unknown interest rate. So a really difficult thing to deal with. Eliminating that is a huge win for the executive. From the credit union standpoint, is it a win for them as well?
In my opinion, yes, it is, because now they've made a loan that they're accruing interest on, and the others in the forgiven interest model, they're not getting anything. They made $1 million loan. That's all they're going to get back at death is $1 million, as opposed to $1 million loan accruing at 2%. The AFR is actually a little bit lower than that right now. They're accruing 0% interest. So from a credit union standpoint, we feel it's better for the credit union. It's also based on assumptions. So if I'm assuming that that loan is going to accrue at 1.74% interest or 2% interest, but I'm also assuming that my policy is going to provide a 5 to 6% return, not guaranteed, but assuming that it's going to provide a 5 or 6 rate of return, that's arbitrage right there, right? You're lending money at 2%, but you're getting money at 5 or 6% tax-free. And so there's arbitrage there. So to me, that makes the most sense. Everybody wins in that situation, as long as our assumptions hold true for the next 35 to 40 years.
Yeah, and you had mentioned cost earlier, and I was thinking to myself that if I understand the way the industry uses these tools, if you loan more money to the policy pays the credit union back when the executive passes away, plus interest, right? And that's what they're accruing along the way, is this accrued interest on the loan, and they get that all eventually, assuming the executive passes away and the policy still exists. Is that right?
That's correct. At the time of death of the executive, the credit union will, in fact, get their loan plus interest back. That's a very important lead into really another piece of the design that I think is very important. And this is something that we don't always see from our competitors, is that when that death is assumed, okay, if I want to keep costs down And I assume that that executive is going to die at mortality age 82, 83, 84, depending on the health of that executive. I need to make sure that the death benefit from that policy covers my loan plus interest through age 82, 83, 84, right? There has to be enough death benefit so when the executive dies, that death benefit, as you mentioned, goes back to pay back that loan plus interest. If the executive lived past that, what happens is if there's not enough death benefit to pay back that loan, then the credit union has two choices depending on the plan design. They can go after the executive beneficiary if it's written into the design to make up for any shortfall that the credit union didn't get back based on the death benefit versus the loan plus interest. So that's one thing. So they can actually go after them. So if the loan balance has grown to $4 million, but there's only $3.5 million of death benefit left in the policy, depending on the design, we call that a recourse design. The credit union can go after the beneficiary to say, you owe us $500,000. And we do see those types of designs out there.
Wow.
Yep. The other thing that the credit union can do is just forgive that interest, not go after this. That we would call that a non-recourse loan. So they can't necessarily go after the executive for the shortfall, but the beneficiary in my example where the loan balance was $4 million and the death benefit was $3.5 million, that becomes forgiven interest again. There's that term again. So the beneficiary or the executive has $500,000 of forgiven interest, which will be taxable. So while they're not going to have to pay $500,000 back to the credit union, they're going to have to pay, if they're at a 40% tax rate, $200,000 of forgiven interest to the government, which I know is not going to make very many people happy. So circling back to the plan design, designing a plan that only covers the loan balance to mortality age is, in my opinion, a bit risky, and I don't think that's best practices. We always typically build in a little bit more cushion and make sure that based on our assumptions, that loan balance is going to be covered all the way through age 99. Do we think all of our executives are going to live to age 99? Certainly not, Doug. Certainly not. But what that does is it provides that extra cushion so that A, the executive can get that benefit that was originally projected. B, the credit union is always covered to get their loan plus interest back. C, there's no shortfall, so no recourse and no tax. And then D, something that we haven't talked about is when there is excess death benefit. So the executive has received their income stream and now they're at age 85 because they started at age 65. They got 20 years of benefits, and that executive is still playing golf and having a great old time and lives for 6 more years. Fabulous. Lives till age 91. Remember, our plans covered that loan plus interest to age 99. So at age 91, the loan, there's still plenty of death benefit to cover that loan. In most cases, there's excess death benefit above that loan balance. So let's go back to that $4 million loan balance, right? Maybe there's $5 million of death benefit in that policy. What happens to that $1 million, Doug? Well, there's a couple different things there. One, what we typically see, the majority is any excess is split 50-50 between the executive's beneficiary and the credit union. So another benefit to the credit union. Not only are they getting their loan plus interest, but they're also potentially getting a piece of any excess death benefit. I want to be clear, that is not the only plan designed 50-50. Sometimes some credit unions give all of the excess to the beneficiary. Some credit unions keep all of the excess, and then we see everything in between, but typically 50-50, because that's again, a benefit for both. It's a benefit for the executive's beneficiaries. It's a benefit for the credit union. By designing the plan out to cover through age 99, and again, assumptions coming true, that provides additional benefits to both parties. Very important in design.
It's interesting. I have seen that. I have seen any additional wins, the policy ends up being better than projected. I've seen it where the credit union gets all of that. Sure. And I've seen it more frequently where the executive gets all of that. I've actually not seen a 50-50 one yet.
No, that's funny. No, and they're all out there. They are all out there. I can't give you percentages out there of what is out there, but they are all out there. But the key takeaway is that's part of the plan design. And one is not necessarily better than the other. Certainly 100% to the beneficiary is better for the beneficiary, and 100% to the credit union is better. But one is not a best practice or a better design. But the key there, Doug, is to go back to when are we looking at that? So if we're only covering to age 83, 84, then it doesn't matter how the excess is split if there isn't any excess. And that's the key there. I want that to be the takeaway. Yes, different design options, but the takeaway is to make sure that there is excess, which can be split if desired.
Yeah, what I'm hearing from you, Matt, is don't risk underfunding the policy, because the problem for the credit union and the executive can be very large.
Absolutely. And I don't know about you. I don't want to be the one going to that executive's beneficiary who just lost their spouse and say, oh, by the way, he or she had the split dollar plan and it came up short, and now you have a tax bill that you owe to the government. I don't want to be the one to say that to them. Okay. I'd rather tell the credit union up front, listen, it's going to cost you a little bit more, but this is best practices. And in the end, it's going to protect both you and the beneficiaries or the executives from any consequences down the road. And that's the key. It's very important.
Awesome, Matt. Great ideas today. Thank you very much for your participation again on the podcast. That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.